Hi everyone, Unity Software reported fiscal 2022 fourth quarter results. I'm going to do a brief review of those earnings results and update my recommendation on the stock. If you've been following the channel, you know that I've said Unity Software stock is not a buy for 2023. The stock is already down after these earnings results came out. So I will update this recommendation by the end of this video, so you're not going to want to miss out. So let's get right into it. So revenue increased to 518 million in Q4. This was up from 473 million in the same quarter the prior year. The net loss worsened to 289 million. This was up from a loss of 162 million in the same quarter the prior year. So it increased its revenues by about let's say 45 million, it looks like, and it lost 127 million more to gain those revenues. So overall, if you compare the quarters, this quarter compared to last year was much worse, and so you can understand why the stock was down considerably following the announcement. If you've been following Unity, you know it announced an acquisition of Iron Source. That acquisition is progressing as planned. No bad news to report from their management said. The dollar-based net retention rate of 116% increased from 111% from the previous quarter, so that was good news. This was after 4 consecutive quarters of declines. The dollar-based net retention measures how much existing customers are spending with Unity. So if someone spent $100 one year and they spent $110 the next year, that would be dollar-based net retention of 110%. So that means existing customers are spending more with Unity, and it's a good sign when it's above 100% because that means existing customers are spending more with your company. They're seeing the value you provide and they're increasing their spending. That's really good news. This was a really troubling trend that it had been declining so significantly after Unity messed up with its its data measurement and advertising side of the business. That's why it made the acquisition of Iron Source to kind of plug up some of those difficulties it was having there. And as a result of those difficulties, those execution difficulties, it was experiencing this decrease of dollar-based net retention. So it's a good thing that that flattened and it's not continuing to decrease anymore. The company's taking actions to eliminate non-core projects and reduce costs. That's good news, right? Because you're seeing the net loss is getting a lot worse, right? And investors are not tolerating these unprofitable growth stocks as much as they were, in 2021 and in 2020, right? And before that, even when interest rates were much lower, investors were more tolerant with unprofitable growth stocks. That's not the case anymore. Investors are pushing companies to get more efficient, to reduce waste, and to start to make more progress towards profitability and positive cash flow. Its cash flow from operations worsened to 49 million. This was up from 39.5 million in the same quarter last year. So it lost more money in cash outflow. The company did repurchase 42.7 million shares of its stock at an average price of $35.10, returning $1.5 billion to shareholders, and it has $1 billion remaining in the authorization. So I like to see share buybacks as an investor. This tells me that management thinks its stock is undervalued. It thinks it can fix these issues that it's having at the company and come out on the other side stronger. So that was good news. And it's forecasting 2023 revenue growth between 47% and 58%. That's a significant increase from the revenue growth rate in the fourth quarter, and it's likely including the revenue growth it's getting from the Iron Source acquisition. Overall, not a very good quarter from Unity Software. The stock was already on. The stock was already not a buy as my recommendation for this year for 2023, and I will update and reiterate that recommendation that Unity Software stock is not a buy right now. It's a little bit too early to jump in here with the stock. The decrease of 10% or so as of after these earnings were announced, in my opinion, is justified, because you can see the loss is getting worse even though the revenue is incrementally going up. I don't like the direction it's heading right now. It's got these problems it needs to solve, and acquisition it needs to digest. I wouldn't want to be an investor right now. All right, so that's all I've got for this video. I appreciate your viewership. I hope you'll come back again next time for another video. See you then. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.